Hello traders, Gary Wagner here, just after 12 noon in Honolulu, 6 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands, May the 10th, 2019. And this is the Daily Report for Gold and Silver, our weekend review. And what a week we have seen. Really strong whipsaw activity in U.S. equities, and the precious metals complex for a change actually had fractional to sizable gains across the board in gold, silver, palladium, and platinum. The trade negotiations between the United States and China began yesterday. They concluded early today. After lunch, the delegation from China left the negotiation table, so to speak, and the best way to characterize real activity was stalemate. Although there were statements from both countries that said that they had made some headway or some ground, to me that was just to appease the masses, so to speak, because they are no closer to reaching any kind of resolution or conclusion to the current trade war. In fact, after raising tariffs last night from 10 to 25% on $200 billion worth of Chinese imports, the Chinese government has now vowed, as they had threatened before, to retaliate in kind to that recent action. That was supportive of the metals, and the biggest move today, of course, was palladium, and we'll talk about that in a second, but let's take a look at our price board. Gold futures closed up fractionally higher, up $1.60 at $1286.80. And we do have an active long position and stop. We'll discuss that in detail as we pull up our technical studies. The least percentage gainer today was silver. And in fact, we can easily make the case for silver closing unchanged, 0.002 or 0.01%. Silver closes at 1477.5 cents. Platinum did quite well, gaining almost $16. $867.30 is the current fixed price. But once again, the real mover was palladium, gaining over 5% on the day, a net change of $65 per troy ounce, with palladium futures closing at $1,348 per ounce. Let's take a look at our technical studies. I do want to start today's show by looking at a weekly candlestick, this of most active, June's COMEX contract of gold. We can see a couple of things that immediately jump out at us. First, by virtue that we have seen a green candle form, that simply is significant in that the market closed above the opening price on Monday. Although the change is not that great, it is nonetheless a green candle. The second thing that we can see is that we did get a higher low than the previous 2 weeks, and we had a higher high than the previous 2 weeks. Most importantly, it tells us that this level of support, which comes in at approximately 1267, is major support. That support level held, and now we're looking at a scenario in which we have a continued amount of resistance that comes in at the 0.38 Fibonacci retracement level, and that of course comes to 1287.30 to be exact. The market closed at 1286.80. So you can see that it closed just at that price point, but a couple of ticks below it, which tells me that there is still resistance in effect. However, we can glean even more information when we convert this to a daily chart. The first piece of information that I do need to talk about is the fact that I have adjusted this data set, which begins now at approximately 1186, and that was a change from using this low, which comes in at around the low 90s. And the rationale behind that is it produces much more clarity in terms of information about support and resistance levels. When we look at the double bottom that occurred on our weekly candlestick chart, what we can see is that even on the daily, it's quite clear that there was a double bottom, and that double bottom was created from 2 days of activity. This day right here and then this day right here. So that's why it was reflected in both weeks of our weekly chart. The other thing that we can talk about is the fact that we still have pretty strong resistance that up until now has been unable to be taken out. That comes in at roughly 1287. On Wednesday, we talked about the identification of a simple pattern that was coined or created by Steve Nissan. It is not a candlestick pattern, but it is nonetheless a pattern that contains extremely valuable information. It's simply called a scouting party. A scouting party is when traders take current pricing above a level of resistance or below a level of support, and in this case, they are testing the fortitude of the bearish camp. And the fact that it traded above this but then closed back below it means that the fortitude of the bearish camp was still fairly strong at this price point. That was a price point they would go in and sell the market. The other thing about the scouting party pattern is that if in fact you get a close above current resistance, that resistance becomes support, and he has labeled that as a beachhead. And we certainly did not get that this week. You can see areas in which a scouting party prevailed, such as right here. You can see that the market traded above that price point, and from there, the following day had a low in that area, although the change was nominal on the day, but that did really create some upward momentum, taking prices higher. My sense is that there is a very, very decent probability that we will see gold trade higher next week and that we will close above this key level. Which brings me to our current trade and our exit strategy. We are long from 1285. We got long at the beginning of the week, and then although we had one occasion where the market traded well above it, it did not close above that. And so my sense is that if, as I believe we will, see prices move above that key level of resistance, first, that level will become support. And then most importantly, we want to put a price order in for our exit strategy on the upside. We have a protective stop currently at 78. If the market breaks below there, it would stop us out with a very small loss. However, if we do see a solid break above this particular price point, my sense is that we've had these series of lower highs, and so I would look to put a price order in to get out at 1310. That can be put in as a limit order, or if permitted by the company you trade with, an OCO order, which simply means that one cancels the other. On an OCO order, if the 1310 is executed, they will cancel the stop automatically. If in fact you're unable to use that strategy in OCO, simply put a limit order in to sell at 1310, and then remember to cancel your good till canceled stop sitting at 1278. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.